I'm not a financial advisor. This is not financial advice. Please do your own research. Welcome to the Vinny G Markets channel, brought to you by Vinny G Money. Now, we had a lot of unusual activity in a sector that we're extremely bullish on this channel, so that's the purpose of this video. But before we get into that, let's take a look at the markets in general. All three major indices basically did the same thing. The S&P 500, it did start the week pushing higher. Then around Tuesday, Wednesday, it started going down. Same thing with the Dow Jones, finished about flat. But Tuesday, Wednesday, you see it was pushing higher, but then took a tumble midweek. And it's same thing for the NASDAQ, finished about flat, midweek started pushing down, but you know from our last video we were expecting some type of pullback, and we could continue to pull back. Reason being, when that US 10-year Treasury was shooting higher, so was the market, and we were looking at that as some type of inverse. And taking a look at the US 10-year Treasury this week, you see it did cool down. We settled at 2.39 at the end of the week. It was shooting up on Friday, but it did cool down again to that 2.39, where I think the market is liking it right now. We'll pull up the US dollar index. That US dollar index, it did start the week off a little bit high at around 99. That too, it cooled off at 98.57. Really nothing to see here. And that brings us to our third indicator and the point of this video, crude oil. Crude oil down big time this week. We did start off over 100, and it did, you could see this was about Tuesday. We pushed to about 108 before it dipped and settled at the end of the week at 99.42. And I'm sure a lot of people already know the price action. It's due to the decision of our US government to release 1 million barrels of oil per day from our strategic oil reserves. And if this was actually going to help the people with the price of oil and energy, I'd be all for it. But since it's not, I'm taking this personal against my investment strategy. And what we gonna do, we gonna clap back, hit him with the quick jab. Got my drink and my two-step, so let's get down to business. And we're not even going to need to spend a lot of time on this. We're just going to take the different scenarios, toss it into an equation, and from that equation, try to decide whether the price of crude oil and energy is going to go up or down going forward. But the US to release 1 million barrels of oil per day from reserves to help cut gas prices, and this is from the White House itself. The scale of this release is unprecedented. The world has never had a release of oil reserves at this 1 million per day rate for this length of time. The White House said in a release, this record release will provide a historic amount of supply to serve as bridge until the end of the year when domestic production ramps up. So the United States is going to follow through with this plan to release an additional 1 million barrels of oil per day. How many barrels of oil is used in the United States on a daily basis, one might ask? It's about 20 million barrels per day, so we're going to be about 19 short on a daily basis. This is really going to do nothing but drain our strategic oil supply, but we're not done with this equation yet. This gave the excuse for OPEC to not ramp up its production, and the very next day we have this: OPEC sticks to modest oil output hike as US considers unprecedented release of reserves. Energy analysis had widely expected OPEC to rubber stamp another modest monthly increase, despite sustained pressure from top consumers calling for the group to pump more to cool soaring oil prices. And to make matters even worse, even these agreed upon production increases, the modest ones, OPEC, they're not even honoring those. We have right here, OPEC output rise in March falls short of pledged increase, and this came out on April 1st, and it's not an April Fool's joke, but OPEC's increased oil output in March fell short under its target under a deal with allies, so they're not even producing what they're saying they're gonna produce. And if you've been following the Vinny G Markets channel since day one, you know this is nothing new. We could go over our endless videos that we put out where we know OPEC, they've been constantly doing this. Even the modest increases where they need more, they're not even reaching those targets as well. This has been an ongoing issue for the past year. And to add fuel to the fire, we also have Russia to demand oils and rubles. That's coming very soon, and they haven't backed off this. And to add even more fuel on the fire, we have Russia's biggest bank has been cut out of the global financial markets, now launched a cryptocurrency. We have Russia's biggest bank got permission to issue a digital currency just weeks after the invasion of Ukraine. The US and its allies are concerned about Russian use of crypto to circumvent sanctions. Since Russia began its war on Ukraine, a host of restrictions have been imposed on the country, cutting it off from its foreign currency reserves and the global financial system. In the midst of all this, Russia's biggest bank launched a cryptocurrency, and what we say in our last video, all this, it's going to lead to a currency war. This and other situations down the line as well. And these currency wars, they're going to turn into real wars. And by definition, these emergency oil stashes that we're tapping, the Strategic Petroleum Reserve, it's a stockpile of crude oil that the U.S. maintains in case of emergency. Its supplies are disrupted, such as by a hurricane or a war. The U.S. can tap the reserve and avoid catastrophic shortages. So we're already tapping into these oil reserves without directly being involved in any type of war. So again, I'm not a financial advisor. It's not financial advice. You got to do your own research. But when I put all this into the equation, I do see crude oil and energy going higher, despite the fact that we're doing this oil reserve tap. It's going to do absolutely nothing but drain our oil reserves when we actually need it down the future. So the best analogy I could compare this to is if you have a bully that bothers you on your way home from school, instead of confronting that bully face to face, you take the longer route home to avoid any potential type of face-to-face conflict. And because I'm taking it personal, I'm going to expose this plan even more. We already tapped into these oil reserves back on November 23rd, where the administration agreed to release 50 million barrels onto the market. And that short term dropped the price of crude oil. On November 23rd, crude oil was pushing $78. It did fall below $70 in the short term. But when 2022 started, we see crude oil just started pushing back higher, which is what's going to happen again this time around, but it's going to push even higher past those $130 levels. We're just setting a new floor right now for the eventual leg higher to a higher high. And if you actually understand, like we go over in our prior videos, the NWO's agenda, it's to wipe out the middle class. How they're going to do it? Through rapid inflation. So when you take a look at it through those lenses, this is all being done purposely for the eventual increase, like really big increase in the prices of energy going forward. And just to show again that we're not just making things up here in the Vinny G Markets channel, we have BlackRock exec says entitled generation who has never had to sacrifice will face shortages. For the first time, this generation is going to go into a store and not be able to get what they want. We have a very entitled generation that has never had to sacrifice. Also adds, I would put on your seatbelts because this is something that we haven't seen. And why is this so important? It's because BlackRock was hired by the Federal Reserve. BlackRock, which manages about $7 trillion in assets, was hired by the Fed in March to steer tens of billions of dollars in bond purchases as part of the U.S. central bank's efforts to stabilize the bond market amid the economic turmoil caused by the C-word pandemic. And that $7 trillion turned into $10 trillion last year. We have BlackRock surges past $10 trillion in assets under management. New York-based BlackRock said on Friday that assets grew 15% in the fourth quarter to reach $10 trillion, led by inflows to its iShares exchange-traded fund platform, and more unusually, its active strategies. BlackRock delivered the strongest organic growth in our history, even as our assets under management reached new highs, Larry Fink, chair and chief executive, said in a statement. So we can easily see, and also as reported, BlackRock is the biggest beneficiary of Fed purchases of corporate bond ETFs. As the Federal Reserve began its historic purchases of corporate bonds, exchange-traded funds, almost half of the Fed purchases went into BlackRock funds. And none of this is really a secret. We even have Bloomberg reporting in Think We Trust. BlackRock is now the fourth branch of government. When the Fed looked for bond buying help in a crisis, it turned to giant money manager. When Federal Reserve needed Wall Street's help with the pandemic rescue mission, it went straight to Larry Fink, who's the CEO of BlackRock and has become the industry's most important government whisperers. Again, this is all reported by Bloomberg. So since we know BlackRock's relationship with the Federal Reserve and the Federal Reserve runs everything, you could either take my word for it or do your own research. That's up to you. But when BlackRock sends out these warning shots, we gotta listen. And now you have the United Nations reporting on a food crisis. The war in Ukraine is creating the greatest global food crisis since World War II, the UN says. The UN food chief warned Tuesday the war in Ukraine has created a catastrophe on top of a catastrophe and will have a global impact beyond anything we've seen since World War II, because many of the Ukrainian farmers who produce a significant amount of the world's wheat are now fighting Russians. David Beasley, executive director of the UN World Food Program, told the UN Security Council that already high food prices were skyrocketing. And you know the Vinny G Markets channel was reporting on this in our blueprint video last week, continuing to keep you ahead of the game. So with all this news regarding different crises, we also have an inverted yield curve presenting itself, and a lot of speculators saying that this inverted yield curve is going to crash the markets. All an inverted yield curve really is, it's just when short-term debt instruments have higher yields than long-term instruments with the same credit risk profile. And we actually touched on this in our blueprint video where in 2019 an inverted yield curve was presenting itself. And that inverted yield curve, it's just an indicator that a recession is coming or on the way. It has nothing to do with market crashes. And the reason why I'm not worried about an inverted yield curve is because we're well beyond a recession. A recession will be a step up from where we're at in the U.S. economy. The U.S. economy is done. It's been cratering. We've been going over this in all our videos. You can check out all the prior videos we have to this. There's nothing good about the United States economy. A recession would actually be an improvement from where we're at. So the inverted yield curve at this point in the game, to me, it's just nothing to concern myself about. Because like we said in our prior videos as well, the worse the economy is, the better the stock market's going to be, because how's the Federal Reserve going to taper with the economy in such bad shape? And I believe a simple combination of these recent reports exemplifies all this. We have 1 in 5 workers run out of money before payday. More people living paycheck to paycheck. At the same time, U.S. corporate profits jumped 25% in 2021 to record high as economy rebounds from pandemic, even though the fourth quarter GDP growth was lowered to 6.9%. But the adjusted profits, that's the largest gain since 1976. All at the same time, there are now a record 5 million more job openings than unemployed people in the United States. So we can obviously see that salaries just aren't keeping up with inflation. There's still big problems in the labor market. All at the same time, corporate profits are just soaring to levels we've never seen, which gives me all the proof I need to see that we're well beyond a recession. Again, a recession will be a step up from where we're at right now. And we all know from our blueprint video last week that the Federal Reserve solution to all this is to raise interest rates, but we know raising interest rates without any type of tapering, it's going to continue to fuel this scenario where the U.S. economy continues to go down the drain, but the stock market goes higher, further killing the middle class and making the rich even richer. And I did want to touch on the real estate market a little bit, as I did find something on the Federal Reserve website. This is the agency mortgage-backed security historical operational results and planned purchase amounts. And if you've been following the Vinny G Markets channel, you know the Federal Reserve since the 2020 pandemic, they've been buying a minimum of $40 billion worth of mortgage-backed securities every month. And we see from this website, if I'm reading this incorrectly, please let me know so I can learn something. But from this website, you see since 2020 through 2021, the purchases have been well over $100 billion every month. But we see within the past few months, those purchases have been well under $100 billion. So I think we're starting to see the Federal Reserve actually pull back on the mortgage-backed security purchases. And we've been stating that. We've said that this could be the first thing that they actually do taper on, where they could still continue to buy assets, but just not all these mortgage-backed securities, because there's really no excuse for them to buy these mortgage-backed securities anymore due to the real estate inflation that's going on. And it's to my belief, without the Federal Reserve being a guaranteed buyer of these mortgage-backed securities, less loans are eventually going to be lent out, especially at higher interest rates. As we know, the mortgage interest rates are actually rising faster than the U.S. 10-year Treasury, and we're already seeing mortgage company stocks, they're beginning to plummet. But the only thing that's helping the real estate market present day is that low inventory combined with still a bunch of people looking to relocate. It's the only thing I could think of that's still keeping these prices inflated, which is all artificial. But that combination of low inventory and people looking to relocate, it's like having a full house, yes, pun intended, in poker. But we all know what the wild card is, the low spade in the hole, and that's 3D houses. You could check out past videos for that, and I'll leave a clip at the end of this video which goes into how the Federal Reserve, they're not going to be able to sell off these mortgage-backed securities they bought because investors know it's all junk. Because as a recent report shows that home buyers' monthly payments are up 25% to record highs, and when you combine this with other inflation through goods and services, people just aren't going to be able at one point to pay these mortgages. It's going to be like student loans where it just becomes unpayable because the amount is so high, and just the economic conditions going forward aren't going to help the cause. But corporations and big time investors that have been buying real estate either for rental properties or even a place just to park their cash, as we can see that 1 out of every 10 real estate homes, they're vacant. These are vacant because it's just being used as a place to park cash. They don't even want to rent it out to people. Reason being is they want to be able to get out in time as soon as they see the market start cracking, or if they don't get out in time, they'll either get bailed out or these corporations are going to withstand it because they get an income from these properties anyway. This is only going to further destroy the middle class, a drop in real estate, which is the overall goal of the NWO anyway. So, hey yo, if I gotta be the bad guy in this situation exposing these planes, it is what it is. But come mess with your boy if you like what you hear. Hulk smash that like button. And as always, I'll leave you off with this. The God of the Bible, the God of Abraham, the Father of our Lord and Savior Jesus Christ is real, and may he bless you.
Now, when it comes to housing, how and when the Fed unwinds its balance sheet could have a huge impact. That's because the Fed is currently sitting on $2.7 trillion worth of mortgage-backed securities. It's the largest holder of those assets. And selling, according to my next guest, would create huge dislocations that could put even more upward pressure on mortgage rates. Joining me now is Walt Schmidt. He's Senior Vice President at FHN Financial. Walt, it's great to see you. And would you say it's gone from being a remote possibility to a bigger one lately, that the Fed could actually try to sell these assets?
Well, thanks for having me, Kelly. Certainly, it's something that's been talked about a lot more here lately. It's something that we never considered really could even happen, but certainly some of the Fed governors have started talking about it. I think this very conversation really has to do with the tension that we have with monetary policy between theory and practice. The Fed obviously wants to get inflation under control. They've talked about the fact that in the long term, they don't want to have a large holding of mortgage-backed securities. And so then it becomes a matter of timing. And of course, as we've heard a few times throughout the morning, the yield curve potentially is about ready to invert.
Right.
So I think this tension between practice and theory is what we're really talking about.
Basically, the concern is who would buy them. You know, if the Fed holds, $2.6 trillion, the rest of the banks altogether hold less than $3 trillion worth. You throw in a couple $100 billion for the asset managers. Who's going to buy them?
Well, that's the whole point. There really isn't a buyer type out there that's large enough to take on this paper. It's one thing for the Fed to buy $3 to $5 billion worth of mortgage-backed securities per day. It's much, much more difficult to sell them. In addition to the numbers you just quoted, right now, I just looked at the data here recently, all primary dealers that hold mortgage-backed securities only own $50 billion right now. So if the Fed were to put out bonds for those dealers to bid, it would very quickly overwhelm what their balance sheets have. So one would anticipate some sort of auction process. And then, of course, we think back to Maiden Lane back in 2010 to 2012 when they sold assets back then. But Maiden Lane was only $60 billion. We're talking 2.6 to 2.7 trillion.
Wow.
So it's a very large piece for the market to have to absorb.
Do they have to sell? Could they just sit on this and go, you know what, at some point everyone pays the mortgage off and these will just run off on their own?
Well, we think that's what's going to happen, right? I mean, if you look at how pay downs are happening right now, a couple months ago, we were paying off at 20% per year. Now we're at a rate of about 10 to 15% per year. If you look at that and take that out into the future, the average life then of what they own is about 7 years. So you could see a much smaller portfolio over 7 years. And again, it's just more of a problematic thing. Yes, they'd like to have fewer mortgages, but it's very difficult. And the last point I'll make is the point that Diana made, and that is simply the fact that the market's already done the work for the Fed, the Fed's own work. If you look at mortgage rates, they were below 3% just a few months ago. Now they're almost 5%. So monetary policy works with long and variable lags, as Milton Friedman said. So perhaps the Fed now is willing to let that happen and see what happens to the housing market going forward.
Sure, because we're just in the early innings of this. What's been going on with the spread between treasuries and mortgages? Has that widened at all, or could it widen? In other words, right now, mortgages have basically tracked the upward move in rates, but at some point, could they become more decoupled?
Well, it already has decoupled quite a bit. So if you look at MBS or mortgage-backed security spreads to treasuries, those have widened on the order of anywhere from 40 to 60 basis points, 0.4 to 0.6%, just depending on what type of asset you're talking about. It would certainly widen more, in our opinion, if they were to sell or anticipate that they were going to sell. Last week, we heard some rumblings from the FOMC that might be a possibility, and spreads widened quite a bit, on the order of 10 to 15 basis points just last week alone. Already today, spreads are performing well again. So I think the market started to pull back a little bit from that idea of Fed selling. But you're going to have more Fed governors on your show, I think, later today and then in the coming days. And so we might get more information from them. Just from a market practitioner standpoint, though, it seems fairly problematic, at least at this point, given the size of the portfolio, that they would be able to unwind it very efficiently.
Yeah, so we'll be listening for any hint that they might feel that they have to at this point, but maybe they feel comfortable watching rates do what they will. Walt, great to have you today. Thanks so much. We appreciate it.